Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, hi, Jim. Good to be with you and with our listeners.
And we have several listener questions to go through today. So our first one comes from Justin. He says, hi, Wells Fargo recently stated that they are ending lines of credit and home equity lines. Why would they be doing that with banks choking on liquidity right now?
Yeah, this was an interesting move, and I read about it as the story broke, and in 2020, I think it was, or thereabouts, Wells Fargo had some problems with retail loan accounts. Let's just call it a problem. But this thing seems distinct that they are, of course, many banks will have lines of credit set up ahead of time for companies and also individuals, so that by paying a slight fee for having that backup credit for when you need it, that's the way it works. So with this one, they just suddenly canceled personal lines of credit to individuals, not companies. A 60-day notice, that kind of thing. And some have written that maybe Wells Fargo would rather do credit card business instead of that, but it's their decision. But also, it prompted a recall of what the great Austrian economist Ludwig von Mises observed about at the end of a great boom. Bankers didn't have to call loans in order to start the contraction. All they needed to do was get a little concerned and stop making them. So net on this is that Wells Fargo has set up so that they will stop making loans to individuals. That's the net of it, I take. So it'll be fascinating to watch. We are in the midst of the greatest credit expansion in history. So, and these have always been followed by contractions. So it'll be interesting to see where it goes. But Justin, thanks for the question. Very timely.
From Wade in Arizona. Hi, Bob. Is the following statement regarding the repo market potentially a problem for the financial markets this year? When a counterparty with zero risk offers a higher interest rate than T-bills, you get a tsunami of cash sucked out of the system straight into the hands of the Federal Reserve. Could this cause a stock market crash?
Yeah, Wade, thanks. That's an interesting way of going about it. The repo market and reverse repos, it gets a little confusing even for me, and I've been on the street for a long time. And it's just simpler to look at it is that those with money to invest will always seek the best return they can, commensurate with the risk they can handle. And the other thing I'm going to add in here is that when you're at the top of a great bull market, where I think we are now, is that there are bids for everything all over the place. Real estate, low-grade bonds, stock stories, new issues, IPOs. There's bids everywhere. But as we can see by looking at the New York Stock Exchange margin debt outstanding, hey, it's been to the moon. So it gives you, all these bids gives the appearance of liquidity when actually it's borrowed money that bids it up, and that ain't liquidity, it's the opposite. So this is where, when a financial frenzy like this ends, the reversal, when it comes in, is very sudden, very nasty, and not being flippant, but the power shifts from the central bankers to the margin clerks at brokerage firms, or the equivalent at most lending agencies. The leveraged account has to get in line, either by coming in with more equity or selling. So we'll see how that goes. But again, another timely question.
From John in Edmonton, how will cash weather the likelihood of an economic downturn? Is cash nothing but trash, or the basis of a future opportunity? Yeah,
good play on words. Of course, with cash, and historically it means, currencies, banknotes, gold coins, that is always ranked as cash. But in T-bills, GICs also, those sort of things, let's just stay with T-bills, and they're close to zero, and in a contraction they will go to zero, but you'll get your money back. And when we want to look at this as a liquidity issue, that, as with the previous question, there is no real liquidity out there. So the appropriate strategy is to build liquidity in your own account by selling the hot games. And that's one step, just to have the liquidity. Very important. The next step is to get somewhat of a better return than from Treasury bills. And I've suggested, in the 3 to 4 year corporate bond market, good grade bonds, you're going to get a better return, and the risk of price hits is not huge with something, say, a 3 or 4 years maturity. And if you have a good corporate bond, it likely will be redeemed. So now, also, those of us in Canada buying U.S. good grade corporate bonds, you're going to get a bang out of the U.S. dollar going up relative to the Canadian. So it takes a bit of work to find an investment dealer that will trade in 3 or 4 year maturity good grade corporates. But hey, having a good portfolio always takes some work. So that's an ideal solution. And also the old one about having some gold as an insurance, that always works. But as far as gold shares go, they may be vulnerable to a broad sell-off in the New York stock market.
From Chris in Rhode Island, hello, Jim and Bob. Does the Dow gold ratio have significance anymore? I remember Richard Russell, a well-known Dow theorist in his day, suggested that this ratio will go 1-to-1 or below at secular financial market bottoms. Could you share your research on this and perspective over the years?
Yeah, that Dow gold ratio is a good thing to look at, and I have always had a high regard for Russell. He had some good comments from time to time. I think his best one he would use at the top of a bull market, and he would say that stocks are going to go to great valuations again, and that means like going from a 1% dividend yield to a 6% dividend. Often bear market lows, the Dow would trade at a 6% dividend yield, and that's a long ways away from here. But on the question regarding stocks and gold, it gets very interesting in a financial mania such as we're completing possibly in the next month or so, the real price of gold has gone down in financial bubble, and indeed the real price, as we watch it, that's deflated by the CPI, has declined since a year ago. And with it, gold stocks have underperformed the Dow and cryptos and everything else. But the way it works, one more point on what happens in the final stages of a great financial bubble is that we were able to do the real price of copper back to about 1825, and the real price of copper goes up in the final stage of a great mania, which it has done, and then it goes down. And this is where the reversal comes in, is that everything falls relative to gold. So the real purchasing power of gold goes up. It improves profit margins of gold miners because their costs are falling. And then this is where in previous post-bubble contractions, one can use the word depression, that you've gone into a terrific multi-year bull market for the gold stocks because gold was outperforming everything else. So with this bubble, base metals up, yes. Gold down, yes. And then somewhere over the next few months, this should reverse with base metals heading down seriously and gold's real price going up. But unfortunately, the possible contraction will push down stock prices and will take the gold stocks down with it. So what we're watching for is, with our technical tools, looking for the next buy on the gold sector. We had that a year ago because, hey, it was just almost a runaway market, and that's when we advised that both traders and investors should take money off of the gambling table, which it had become. So that was timely, and hopefully our next entry into the golds will be, hey, let's use the term, Jim, timely. Thanks for the question.
We'll be taking a look at some financial headlines when Bob Hoye returns.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, canola futures are skyrocketing over drought concerns. Is that something that's general in the agricultural sector right now?
Oh, yeah. The Great Plains have been dry. They had, I think the grain growers got some good seeding in, but and a good start. But no, they need some moisture here now. And but I think the grains had a terrific rally and reached excesses 6-7 weeks ago, and we'll see how it all turns out. But it's being used as, in the 1970s, inflation is coming back, and food costs are going to go to the moon, and all that sort of stuff. But I'm not taking that story. The big story is that the inflation is in financial assets, and that's where we want to see what's coming in the fall.
Inflows into equity funds are smashing records. Why?
Oh, people are buying the stock market, and one of the, I guess, more efficient ways of buying it is, rather than working out a portfolio of 10 stocks, people are just buying ETFs, whichever way they can, or mutual funds. More ETFs these days, so some mutual funds are being turned into ETFs. But it just shows a terrific passion for buying stocks, and this is now measurably terrific, and at about the right time, because we were looking for terrific rallies in stocks and basic commodities into around mid-year, and in a number of cases, examples, we've got the excesses one would need to build some liquidity on. So, well, right timing on and these headlines are important because rather than just looking at a chart and some numbers, you've got a real statement on what's going on. And this one is that the public is buying equities at a terrific pace.
Inflation. Is it the silent killer?
Yeah, that was the headline. Yeah, the problem with the old-fashioned 1970s inflation, that was also the case in the 19-teens up to 1920, is that for most people, the cost of living goes up faster than their wages or earnings are going up. And it's very distressful. I remember 1970s, that was very uncomfortable. Sure, we in the investment business were making more money than most, but it was still there, the tension. So, but historically speaking, the last big boom in commodities was outstanding, and that completed in 2011. And then historically, what has happened before is about a decade later, you have a huge inflation in financial assets, stocks and bonds, which is very much on. So what's going to happen next is that as this bull market matures and rolls over, then it's going to be followed by deflation in most asset prices. So commodities, real estate, stocks and bonds and junk bonds are going to will eventually be heading down.
Corporate insiders, well-timed share sales. Well, haven't they always done that?
Oh, no, there are times when corporate insiders, they have to report as an insider. And it's always a month or so late, but anyways, you have to file your insider reports. And there are times when insiders will be buying, and depending on the degree of buying, it can be important information. And then at the same time, here we are in a runaway financial bubble, and it's interesting to see that corporate insiders are selling. They know they have a pretty good handle on the valuation of their stocks. So it's just an indicator that in this case, an informed portion of the investing public is lightening up on their positions, which is, to my mind, appropriate in this kind of a market.
Fake synthetic equities trade 24/7 on crypto exchanges. What's the story there?
Oh, yeah. I love this one because a few weeks ago I wrote a piece on in the United States and in Canada, a long time ago, there used to be what was called a bucket shop. I don't know why that name, but it was a bucket shop had a ground floor retail premise where walk-in trade could come. They'd have a customer's room with chairs, and then they'd have a blackboard up with clerks putting up the price of stocks on the exchange. But the bucket shop didn't have a seat on the exchange, and the orders entered were kind of like wagers against, a stock going up or a stock going down. They could play it either way, long or short. But the transaction was kept in-house and not entered on the exchange. So this is how retail accounts were playing the market. And it was also a bit designed such that those who were operating the bucket shop always made money. And then, as I said, I wrote this one up a few weeks ago, and this bucket shops were in sort of like New York and Philadelphia, in important business centers, and until about the 1920s when authorities began to shut them down. But this is the clearest example of a bucket shop because they're set up to transact items that are against crypto stocks or any stocks like that. So they call them tokens. They were set up to reflect the price of the securities they track without making any actual transactions. So this is the closest to a bucket shop from the 1920s that I've seen. So again, an example of the public being very willing to speculate, and in this case, 24 hours a day, 7 days a week. That's astounding. One of the things years ago in the 1920s and 30s was the New York Stock Exchange would be open for trade on a Saturday morning. But, that's not happening anymore. I don't even know when that ended. But here you have now something set up so that you could trade 24 hours a day if you wished. It's an example of the frenzy, the buying frenzy of our time in the greatest financial bubble in history.
Bob, thank you so much for being on the show.
Yeah, Jim, good to be with you. And I'm looking forward to next week.
And we love to hear from our listeners. Bob likes answering your questions, loves answering them, actually. You can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.